Preparing a balance sheet. Hi, I'm Justin Late from Think Numbers, and in this lecture we're going to take a trial balance and we're going to turn this into a balance sheet. And in the following lecture we'll be turning this trial balance into a profit and loss as well. So we're back looking at this sample trial balance again, and what the first thing you need to do is let's quickly jump over to this next sheet. I've actually created this sample balance sheet here with the different categories, the current assets broken into the typical type of items you'd find on a normal balance sheet, right? So cash, accounts receivable, inventory, other. Then you've got some non-current assets. In some organizations, you can have accounts receivable over 12 months old, inventory, fixed assets, intangibles. Now, the reason why we've got them in two categories, you can see the accounts receivable in both categories. Remember that current actually relates to anything that's liquid less than 12 months old. Okay, so if you've got customer debts that can be that have been collectible within 12 months, but if they're over 12 months old, on some annual reports you'll see them actually broken into a non-current asset. And likewise with inventory they've been holding for greater than 12 months, you could actually have it sitting there as a non-current asset. So that's just for information, so to avoid some confusion. Then we have some subtotals of the total current assets, the total non-current assets, the total assets, and then we jump into the liability accounts with the accounts payable, the interest-bearing liabilities, and that relates to loans and finance leases. We have, sorry about that, we have some provisions, some other items that we then look at non-current liabilities. So again, accounts payable, you could have some supply payments that are over 12 months old for various different reasons. It could be a long-term project, or there could be some really long-term disputes, who knows. Some loans that are greater than 12 months old. So there could be components that are due within 12 months, so shorter term things like overdraft accounts or finance leases. Generally the component that would be due within 12 months would be there. And then the component that's over 12 months, if you've got a lease that's say 5-year lease, the years 2 to 5 would actually be down the bottom here, and years 1 would be here. Okay, then we look at the net assets, which is really net assets is just the total assets minus the total liabilities equals the net assets. And we use that to balance up because that has to equal the equity account in order for this to balance. And within the equity accounts you have the share capital, any kind of non-controlling interest, so that is really just indirect shareholding, reserves, and retained earnings. So what you actually need to do is, the first thing to do is go back to our trial balance and look at the actual descriptions of what these items relate to, and have a think about, there's either going to be three places that it belongs to. It's either an asset, a liability, or an equity account. So let's have a look. Let's just create a classification here. Okay, so we'll put the account equation there so it's sort of easy to understand. Now, software licenses. Okay, so software licenses, we know that that's actually a fixed asset, so that's actually an asset. Okay, any kind of accumulated depreciation is that, even though it's a negative amount, will also be an asset because it offsets the actual cost amount. So that's the cost of the software, and this is the ongoing depreciation. Again, we'll talk in depreciation in further lectures in a bit more detail. All right, so we continue on down here. There's quite a few. Look down to that point there. A lot of these look similar, like they're all fixed assets. So at this stage, we can classify them all as assets. Okay. Then we've got prepayments, which we know that prepayments are an asset. Loans to affiliate companies. In this particular example, there is a loan. Really, that's money owing to an organization, so it's an asset. Any kind of investments, it's an asset. Trade receivables, as we know, they're assets. These are some other sort of intercompany. You've got a provision for doubtful debts. This is generally would be considered an asset, as it offsets the value of the trade receivables as a provision for any accounts that could be a bad debt. Unapplied receipts. What unapplied receipts are? Cash that's sitting on a trade receivables account that hasn't been allocated at a sub-ledger level. Again, it's an asset, so we'll just call these assets. Other receivables, deposits, revenue accruals, you can see that they're all assets. So we'll call them assets. Input tax, so that's what this is this is the actual GST or VAT on any expenses. And the reason why it's an asset is because the GST or VAT we can actually claim as a credit, because that offsets any GST or VAT or sales tax that we charge on our revenue, so that is claimable from our tax authorities. Petty cash, bank accounts, any kind of deferred expenses are actually considered assets, and deferred taxes. So we'll get to this point and we'll call them all assets. Then you actually go through, so capital, subscriber and retained earnings, that is the owner's equity accounts. And then then we look on to accounts payable, which we know that that's actually a liability account, more AP accounts, payables to employees. Wages clearing is actually a liability account. Salary accounts, other liability accounts. Finance leases are liabilities. Output tax liabilities, any kind of a pension tax accruals, vacation accruals, cost accruals, more cost accruals. So we'll call these all liabilities, right? So that's pretty much the first step you do, is you classify them. Then what you could do is you could say whether they're current or non-current, right? And you could actually go through and work out for each of those. Let's do this quite quickly. So we know that fixed assets down to this point here are generally would be non-current, because generally you purchase assets for a useful life of greater than 12 months. Prepayments, generally you prepay an item, I would say generally for less than 12 months generally. Any kind of loans, in this particular case, I'd probably call this a non-current. Investments, non-current. Trade receivables, any kind of receivable accounts, I would generally think, even down to accruals, tax, cash, deferred charges. I would say most of these are current, because they're all going to be converted to cash within 12 months. The owner's equity, they generally don't have a current or non-current status. And then you work through the liability accounts. Any kind of accounts payable accounts are generally current. Wages accounts, it's always, items that just need to be allocated, so they're current. Other liabilities, so we'll call them current. Once you start to get to the finance leases, there could be components that are actually current and non-current, so that would probably need to be worked out. So we'll probably call it both. Output tax is generally current, because that's the GST that is on sales, so that is going to be payable within 1 to 3 months. That's just a clearing account. A clearing account is just an account where it sits there temporarily, and then you need to allocate it to another balance sheet account generally. Pension accruals, generally pensions, taxes are generally current. Generally then vacate any kind of accruals for employee entitlements. There could be sort of a combination of current and non-current. And then operational cost accruals generally would be current for the current month, I would say, and then year-end audit accruals, current. So once you've actually then classified these, it's then just a matter of going in and actually taking those figures and transposing it onto this balance sheet. I'm not actually going to do this now. I'll complete this and we'll come back in the next video and we'll talk about the profit and loss. See you then.